We have been really spoiled as entrepreneurs and business owners when it comes to IRS audits over the past several years. That's mainly because the IRS has been underfunded, so the audit rates have been way down, particularly for small business owners. But that's changing. The IRS got their funding now. They got their $80 billion in the Inflation Reduction Act, and in the most recent debt ceiling negotiations, that actually got reinforced. So the IRS has their money. They're going to be hiring auditors and coming after small business owners. They make a point of trying to deflect that and saying that they're only going after the highest income earners. But in reality, the highest risk returns are for those of small business owners who are on the smaller side, because they're typically the ones who are more concerned about money. They haven't done proactive tax strategy, and they tend to fudge things a little bit on their tax returns. So that's where the risk is, and that's the IRS knows that, and that's where they're coming. So today I want to talk about 5 things that you can do to lower your audit risk and not have to worry about an audit. Sleep well at night and just know that if it comes, you're going to be okay. The first thing is, if you get audited, don't talk to the IRS. That's like talking to the police if they're investigating you, even if you didn't do the crime. Just don't talk to them. You get an attorney, and the attorney can handle that for you. The same thing is true for the IRS. If you get an IRS notice, have your CPA, a professional, talk to the IRS on your behalf. That will limit the amount of communication that flows to you and the amount of stress that flows to you. And also, and maybe more importantly, it will limit the amount of information, what gets told to the IRS, and keep you from saying something you shouldn't say and from bringing additional risk to yourself. So don't talk to the IRS. Let a professional handle that piece. The second thing is similar, which is have a professional prepare your tax return. Believe it or not, that actually helps. If you submit a tax return that just has your signature on it with no preparer, or the preparer is not a CPA, then you're in a higher risk category. The IRS will look at who the preparer is, and if they know it's a CPA and if it's a reputable CPA, then they will know that there have been several rounds of review that went into the preparation of your return before it was filed, and they'll know that there are work papers that are going to be ready, and that this is not just a return that was filed with back of the napkin numbers. So having a CPA prepare your return will reduce your audit risk. The third thing is regarding your entities. So if you have business income, that should be filed on a separate tax return for audit risk reasons. There are other reasons, tax strategy reasons, why you might also want to do that. But the fact is, a Schedule C or self-employment income reported right on your 1040 increases your audit risk. The IRS looks at those Schedule Cs with a raised eyebrow right from the get-go. You have almost a 5 times higher likelihood of being audited with a Schedule C than if you don't have a Schedule C. And the same thing is true to a lesser extent with rental income. You don't want to report the rental income if you have a rental property right on your personal tax return. You would rather report that over on a partnership return. So business income generally would be reported on an S corporation return, and rental income would generally be reported on a partnership return. And that will reduce the audit risk in terms of your individual return, because you don't have that activity on that return to raise those red flags. But there's a second benefit to it, which is if you are audited, the only thing that's on your personal return, if you filed those separate tax returns, is one single line item. You just have all of the income and expenses are reported on those business returns, and the net profit comes over to your personal return. It's one single line item, and the IRS can't really audit that. In order to audit that separate income information, what they would have to do is open an audit for that 1 or 2 other business entities. Perhaps if you have both business income and rental income, then they might have to audit an S Corp and a partnership. Often those business audits are handled by a completely different team, and it's not uncommon for the IRS to say, it's not worth it. Because what's on your personal return would be so simple and so straightforward that there really is nothing to audit. And in order to get to the audit, they'd have to go through a whole different team. That team may not have interest in pursuing an audit. You might be able to get out of an audit simply by having that information on separate returns, on business returns, and not on your personal return. The fourth area that you should be thinking about when it comes to reducing audit risk is how your expenses are actually reported on your tax return. This is something that is a little bit of an art, and your CPA should be thinking about this as they prepare your return, and you should be looking at it as you review your return. There are many examples of this, but things as simple as you don't want meals and entertainment expense to be too high relative to your income. You don't want things like that that are going to stick out. Another advantage of having your income reported on a separate return, for example with an S corporation, is then you don't have to explicitly show the information for your home office expense. It's just listed as an office expense on the business return. You're not stating anywhere that you even have a home office or that you're taking anything specifically for that. So understanding how to manage your expenses and which line items they go on. Generally speaking, you would rather take a really large expense and break it into smaller components. By doing that and by looking carefully at how you describe certain expenses and what words you use, this can also reduce the risk of an audit. So the way that returns are generally flagged for audits are, first, they go through an algorithm, and that algorithm will look for expenses that are high for a given industry or relative to your income, so that we're not triggering an algorithm to flag your return for review. And that's the second step when it comes to how a return gets picked for an audit. If the algorithm flags it, then someone pulls it up and manually looks at the return. And that's where these descriptions matter. You don't want to have expenses on there that are going to appear frivolous based on their descriptions. That's a little bit vague, but as you look through those descriptions, just be cautious and make sure that you're using descriptions that would appear very ordinary and necessary when it comes to the operation of your business. And again, where possible, divide large expense categories up into multiple line items so that you don't have a single line item that looks suspicious. And the fifth item to reduce your audit risk is documentation. You need to make sure that you have everything accurately documented. The reason why large businesses aren't as concerned about audits is because they have really tight books, and most small businesses don't. If they have any books at all, they're sloppy, they're not well done. It's really, really important for you to make sure that you have well-kept records so that any and all expenses can be shown specifically as to what was paid for. You can have credit card transaction history, you can have bank transaction history, and the bigger you are, the bigger of a target you have on you. So it's really important for you to maintain those records carefully. The other piece that is often overlooked when it comes to documentation and records are your corporate records. Documenting your annual shareholders meeting, documenting your accountable plan expenses for your home office deduction, making sure that you are staying on top of these records. I know you're busy, I get it, but this is important, and this is something that is difficult to do retroactively. So again, your CPA should be prompting you and helping you to update these records at a minimum every time you file your tax returns. But having good books, solid books with reconciled cash and credit card statements, and having good corporate records with corporate minutes so that you have up-to-date information and a corporate book that you can hand over in the case of an audit is also crucial. If you do those 5 things, then you are going to be okay. Just as a review, you don't ever want to talk to the IRS. Second, have a CPA prepare and sign your tax return. Third, take all of the business filings and rental property filings and put them on separate business tax returns. Yes, it's an extra tax return. Yes, it's a little bit of a pain and sometimes an extra cost, but the amount of money that it can save you from avoiding an audit or even being better prepared in case of an audit is well worth that additional hassle up front. The fourth thing that you need to remember is to be careful about how you report line items on your tax returns. Be strategic about it. Don't show too high of an expense in any one category relative to your income. And fifth, make sure that you're keeping good records and that when you file a tax return, you are ready to back up anything that's on that tax return so that if you're audited, it's not a big deal. You have all the information right there, you can pull it out and you can submit it if it's requested specifically. And if you do all those things, you're less likely to be audited and you'll be fine if you are audited. So you don't have to worry about it. You can You can sleep comfortably knowing that an audit is not going to derail you or blindside you and cause you all kinds of problems. You're going to be okay. You're less likely to have the audit. And if you are audited, again, you'll be covered. I hope that helps. If you have any questions regarding audit and audit risk specifically, or just regarding tax strategy in general, and how you might use tax strategy to lower how much you're paying to the IRS every year and to increase your financial freedom and your financial security, go to our website, contigoadvisors.com. There you can join any of our free trainings, or you can reach out for a discovery call where we can learn more about your specific situation and how you might benefit from tax and financial strategy. Thanks.